Welcome to Learn Commerce PU online classes. Don't forget to like our video and subscribe our YouTube channel for all the updates.
Hello students, welcome to second PUC accountancy online classes. In the previous class we have discussed about the theory part of dissolution of a partnership firm. We made a clear distinction between what is dissolution of partnership firm and what is dissolution of partnership. Then we have studied about how to prepare realization account, then combined capital account and cash or bank account, isn't it? That is accounts that are prepared when a firm gets dissolved. Now let me take up the crucial items, different items, how to treat these items in the realization account. I'll take up one by one. Unrecorded assets or liabilities. First one is unrecorded assets or liabilities. Unrecorded assets, that means which are not appearing in the balance sheet. You have a balance sheet with you, given in the problem, that's while giving the question they will give you a balance sheet. In that balance sheet it will not be mentioned. That will be mentioned in the adjustment part. Unrecorded assets are being sold. This instruction will be there in the problem. Then what we have to do is, while realizing all other assets, we transfer all the assets which are there in the balance sheet, that is saleable assets, isn't it? Saleable assets to the debit side of realization account we will enter. Then while realizing the assets, while selling the assets, isn't it, we will make an entry on the credit side of realization account by bank or by cash assets realized. We will enter one by one as per the instruction given in the problem. And along with that, if unrecorded asset is also sold, then you have to record it. After recording all other things, that is debtors, stock, maybe bills receivable, furniture, machinery, buildings, then you have to write unrecorded asset. Whatever value is given in the problem, same amount should be entered and should be added to the total value of the assets realized. That is what you have to do. Clear? Second one is sale value of intangible assets. Sale value of intangible assets. Intangible assets. What do you mean by intangible assets? I already told you in my previous class. That is assets which cannot be seen or touched, but it has a value and it will help the business to increase its profit, like goodwill, trademark, copyright, patents, isn't it? You will get revenue because of that, but you cannot show that asset as such, or you cannot see that asset as such. But you can feel that yes, because of that the value of the business is increasing, or the profits of the business is increasing, isn't it? So if those assets are there in the balance sheet, on the assets of the balance sheet, patent is there or goodwill is there, then what you have to do is you have to transfer it to realization account, no doubt. You have to transfer it to realization account on the debit side along with other assets. But while realizing the assets, while selling the assets on the credit side, you will enter by cash or bank, isn't it? So cash or bank you will enter, under that you will enter all the assets realized, and nothing is mentioned regarding the sale value of intangible asset. Goodwill is there in the balance sheet, you have transferred here at the beginning on the debit side, but while selling, nothing is mentioned in the problem regarding the sale of goodwill. Then what you have to do is you have to assume that goodwill is sold for zero value. I mean, goodwill, there is no value for goodwill. Goodwill is not sold at all, or there is no value for the goodwill, and you should simply ignore the goodwill. You should not record on the credit side. Remember, that is what you have to do. Clear? So, even patent, copyright, trademark, you have to do the same thing. If nothing is mentioned regarding sale of that asset, that intangible asset, then don't record it. Simply forget it. Leave it as it is. But in case of tangible assets, you have to record. What value should be written? The balance sheet value. Whatever is given in the balance sheet, isn't it? The value of the asset, maybe furniture 10,000, you have to record here furniture 10,000. That's all. That's what you have to do in case of tangible assets. Then, what is the next point? That is sale value of tangible assets. I just told you sale value of tangible assets. Tangible assets. In case of tangible assets, I already told you, you have to treat it as asset is being sold. If nothing is mentioned in the adjustment part, treat it as being sold at par value. Whatever balance sheet value is there, write the same value, but you have to show it. Remember. Then, prepaid expenses. Prepaid expenses. What do you mean by prepaid expenses? Expenses which are paid in advance, right? Expenses which are not supposed to be paid, but we paid it in advance. So it is an asset, will appear on the assets of the balance sheet, because if the amount wouldn't have been paid, isn't it, then your cash balance would have been more. Cash balance would have been more, isn't it? So we will enter it on the assets of the balance sheet. It will appear always on the assets of the balance sheet, prepaid expenses. So if prepaid expenses are there, transfer it to realization account while transferring the assets at the beginning. Clear? Then if nothing is mentioned regarding realization of, that is prepaid expenses, then treat it as nothing is realized and simply ignore it like your intangible asset. Intangible asset. In the same way, you have to treat it. Clear? Yes. Then, assets taken over by a creditor. Asset taken over by a creditor. When any creditor takes over any asset from the business, suppose we are supposed to pay 10,000 to one of the creditors, maybe Mr. A is the creditor. From the firm we are supposed to pay rupees 10,000. Now, the creditor says, I will take the furniture for rupees 10,000. I will not receive any money from you, I will not pay any money to you. The amount you are supposed to pay to me, 10,000, no need to pay. And for this furniture worth rupees 10,000, I will not pay anything. That is mutual, isn't it? So in that case, if creditor takes over any asset, then you should not pass any entry in the realization account. Like when a partner takes over an asset, isn't it? We'll pass the entry partner's capital account letter to realization account, and we will record it on the credit side of realization account by A's capital account, asset taken over. But if the creditor takes over any asset, don't make entry on the credit side of realization account. Don't pass any entry there, because creditor is not a partner of the firm. He is not related to the internal management of the firm, so it is not internal liability, it is external liability. So what you have to do is, while making payment to creditors, on the debit side you will make payment to outsiders, isn't it? To bank or cash account, liabilities paid off. There, while making payment to creditors, deduct that amount. The amount of the value of the asset taken over by the creditor should be deducted and net amount should be paid. That is what you have to do. Remember, don't pass entry in the name of the creditor in your realization account. Is it clear? Yes. Then, loan from the spouse or other relatives. Loan from the spouse. What do you mean by spouse? Life partner, isn't it? Maybe Mr. A is a partner, Mrs. A is spouse of Mr. A. Or Mrs. A is a partner, isn't it? Mrs. A is a partner, Mr. A is her spouse. So, depending upon who is the partner, the other person, isn't it? If loan is received from them, we should not treat it as internal liability. As I already told you, if the loan is there in the name of the partner, if partner advanced a loan, it appears on the liability side, yes, loan account. I told you, don't make payment through realization account or the capital account. You have to make payment to the partner from bank account only. Only one entry will come on the credit side of bank account by A's loan account. There you have to make payment. Nowhere else the entry will be there. Clear? So, when a spouse pays the loan to the firm, that we have to treat it as outside liability, because though there is marital relation between Mr. A and Mrs. A, but there is no business relation. There is no business relation. So, Mrs. A is outsider to the business and we have to treat it as outside liability, and it should be transferred to realization account while transferring the liabilities on the credit side. On the credit side, you will write by creditors account, by bills payable account, by Mrs. A's loan account. Because Mrs. A is not a partner of the firm, so it is not internal liability, it is external liability. So I told you all the external liability should be transferred to realization account. So you have to transfer it to realization account. Any loan received from the spouse. Clear? Then, payment of unrecorded liabilities. I already told you regarding this. If unrecorded liabilities are there, like unrecorded assets, isn't it? You should not transfer it to realization account while transferring the liabilities at the beginning. Don't transfer it to realization account because it will not be there in the balance sheet. It is not recorded at all, so it will not come in the balance sheet. So no question of transferring it. But while making the payment on the debit side to bank, to cash or bank, liabilities paid off, under that you have to write creditors, bills payable or any other that is liabilities, then you have to write unrecorded liability, and you have to make payment to that liability. Remember. Clear? Then, any accumulated reserves, profits or reserve fund or any accumulated fund belonging to the partners or even accumulated losses should not be transferred to realization account. I already told you regarding this, that should be treated like we did under admission or retirement. Admission and retirement, we have treated that, isn't it? Straight away we used to transfer it to partners capital account, any profit or reserves credit side, any losses on the debit side, right? That is what you have to do here also, and it should be distributed in their profit sharing ratio. Only one ratio will be there. I already told you there will be only one ratio in case of dissolution of a partnership firm. Then, any loan given by the partners to the firm. Any loan given by the partners to the firm. It will appear on the liabilities side. A's loan account, B's loan account, C's loan account, and they are the partners of the firm, isn't it? That should not be transferred to realization account that should not be transferred to capital account either, but it should be straight away paid through the cash or bank account. So you have to pass an entry on the credit side of realization account, that's a cash or bank account, on the credit side of cash or bank account by A's loan account, by B's loan account, by C's loan account, like that. Whatever loan is there in the balance sheet on the liabilities side, that should be paid on the credits from the cash account on the that is credit side of cash account, that is by A's loan account, loan repaid. No other entry should be possible for that, only one treatment for that, remember. Clear? Yes. With this, everything is clear now. Let me remind you the steps to be followed. I will repeat it once again. To sum up, when you get a problem, remember, you will get a 12 marks compulsory problem from this chapter. One 2 marks theory question and one compulsory 12 marks problem you will get from dissolution of a partnership firm. And the most easiest one compared to admission and retirement, this is far better because there is no goodwill treatment here. Goodwill treatment is not there, so no question of there is even the ratio, only one ratio will be there. No question of sacrifice, gain, new profit sharing, old profit sharing, nothing is there in this, so no confusion. Simply you have to remember which should be transferred, which should not be transferred. That is the only thing you have to remember. I will make a clear distinction now. Which should be transferred? All the assets. That is, while transferring the assets, which type of assets you have to transfer? Both tangible and intangible. Both tangible and intangible. Am I correct? Then what else? All the liabilities, that is liabilities, external liabilities only, external liabilities you have to transfer. Then while realizing the assets, isn't it? While realizing the assets, you have to realize everything, isn't it? Everything you have to realize, including what? Unrecorded assets. Unrecorded assets. Then, while making payment to liabilities, whether instruction is given or not to make payment, but still you have to make payment to liabilities, right? So, liability payment, you have to make payment to all the liabilities plus unrecorded liabilities. Unrecorded liabilities, you have to make payment, right? Yes. Then, what else? You have to make payment for realization expenses. Realization expenses are to be paid. Then, which should not be transferred? Cash in hand, cash at bank. Cash in hand, cash at bank should not be transferred because they themselves are the most liquid assets which cannot be sold in the market. We cannot sell these assets in the market. So, we should not transfer these assets to realization account. Then, if in case of debtors, there is a provision PDD. If PDD is there in the balance sheet, debtors should be transferred at a gross. Debtors should be transferred at gross and PDD should be transferred separately along with other liabilities. Along with other liabilities. Am I correct? Along with other liabilities we have to transfer. So, debtors gross, and along with other liabilities we have to transfer there is a provision for doubtful debts. That's what you have to do. Then what else? Then you have to close the realization account. If credit side is greater, that means it's a profit, transfer it to all partners capital account in their profit sharing ratio. If debit side is greater, that means it's a loss, transfer it to all partners capital account in their profit sharing ratio. Very simple. Clear? Any asset taken over by a partner, give debit to concerned partners capital account. On the credit side, by A's capital account, asset taken over, furniture taken over, buildings taken over, isn't it? If any liability is taken over by the partner, enter on the debit side to A's capital account, realization account letter to A's capital account, furniture there is a liability taken over, creditors taken over, bills payable taken over, isn't it? That is what you have to do. If any creditors takes over any assets, don't transfer it to realization account, don't make an entry on the credit side, but while making payment to the creditors on the debit side to cash or bank, liabilities paid off, creditors total amount minus, that is asset taken over, isn't it? And write the net amount. That is what you have to do. So very simple, friends. Then prepare combined capital accounts of the partners, transfer all the accumulated profits or reserves, isn't it? Then you have to transfer realization profit or loss to the capital accounts of partners. Final balance, you have to make payment to bank or to cash, final payment made. Then by seeing your realization account and combined capital accounts of partners, prepare what? Cash or bank account. That is what you have to do. So I will take up the problem, 12 marks problem in the next take assignment. How will you treat if unrecorded assets are there in the adjustment part,